Alright, welcome to video number 5, where today we're looking at GST. But before that, make sure you click the like button, subscribe, all those buttons. You feel like a good person when you click them, so click them. Yeah. And anyway, we're going to talk about GST. That's more important. GST is Goods and Services Tax. Brief outline. It was the topic of the 1999 election, and as we know, John Howard won, introduced the GST, and their GST, or the GST works essentially as 10% of all goods and services, everything that you pay. There's a 10% added on top that is counted as GST, and you pay that to the government. So if you collect GST or you pay GST, then obviously that will change the GST balance. We're going to look at that in the video just so we understand where that all fits in. But the first rule you need to know is GST is 10%. So anytime we need to calculate, it's going to be 10% on top, or we're going to have to take out GST by division. So we're going to go through all the math there just to make sure everything stays equal. Lastly, when is GST used? It's used only on goods and services. Now, I guess the main thing that comes up is wages. You can't buy people, so that's not a good. So don't put GST on wages, essentially. Also, like loans, but pretty much everything else will have GST on it. So it's a bit of common sense. Is it a good? Is it a service? If it's yes, apply GST. Simple. So anyway, let's tick over. Actually, no, let's go through the theory, the formula first. So the base formula for GST is base price times 10% equals your GST amount. And that new GST amount is added on top. So let's do a bit more of a a more detailed example. So let's have a look. We've got a few little options here. So firstly, we've got $400 plus 10% GST, which is $40. And we need to work out the total price, including GST. Next, on the 5th, we have a blank selling price. We've got the total price, including GST, and you can see the GST there is 10%. And lastly, you've got selling price, $390. The total price, which is including GST, is $429. So we just need to essentially have some math with us to solve this. So it depends what you're given, what formula you use. So if we look at the first, we can see here that we've got selling price excluding GST. All you need to do is times that by 10%, gives you the GST amount. And if we times it by 1.1, we get the amount that includes GST, which in this case would be $440, like so. Next, in the 5th, you see here we've got GST 10%. Total price including GST is $660. So the way we get GST out, quite simply, the way to get GST out is 660 divided by 1.1 takes just the GST out and gives us the base price. And that would be 600. And then the third one, we've got selling price, 390, and total price, 429. The easiest way around that is 390 times 10% will give us $39. And there's a second checking mechanism here as well. If we use the first, we see 400 plus 40 equals 440, and we see that 400, 10% of that is 40. So the math lines up for all of those. And that's the same for the 5th, which is 600, 10% is 60, and then add them together, you get 660. So it's just making sure you pick the right one. So there's a bit of formula here. Now I'm just going to put all of those on the screen. Now, obviously, if you're in a situation where it goes $440, including 40 GST, obviously you just need to use the numbers you are provided. Like, it's just a bit of common sense there. If they provide you numbers, fill in the numbers first, those numbers first, and then go from there. But you should be able to double check the math behind that. It should be able to add up. Again, GST, practice makes perfect. So we're going to extend this through to the year 12 course here. Now, a lot of what I'm talking about applied to year 10, year 11. Now it applies just directly onto year 12. So we're going to have an example on the screen. So we're looking at cash sales, and there is always two parts. And it's great fun. I always love when there are two parts. So on the 1st of May, Gary's Gardening Supplies made $5,000 plus GST of cash sales for the day. And they applied a 100% markup on all goods, receipt 66. So, to do this, we need to calculate GST first. Now, we know GST is 10%. It's given us the base price. We go, and then we know it's plus GST. So, if it's plus GST, to get the new amount, it's times 1.1. To get the amount including GST, to get GST by itself, it's 10%. So, 5,000 times 1.1 will be 5,500, and 5,000 times 10% is 500. So your sales will be 5,000. All the amount the bank gets is 5,500, and the GST is 500. So you can see all those numbers there. They all line up. It adds up, and you can see the bank debit 5,500, GST clearing credit 500, sales credit 5,000. But we now need to account for inventory or cost of sales. Now, there was a 100% markup, so essentially it's the exact same set of math that we need to do. But this time, instead of calculating GST, we need to calculate cost price. So our formula for calculating cost price and selling price is selling price equals cost price times, and then in brackets, 1 plus percentage markup. Now, if we need to get cost price, because we know sales price, that transposes to a new formula of cost price equals selling price divided by 1 plus, this is in brackets now, in brackets, 1 plus percentage, and that transposes for our new formula for cost price. And in this case, it's 5,000 divided by 1 plus percentage, and the percentage here is 100%. Now we know 100% transposed into a number is 1. So it's 5,000 divided by 2, and our cost price is 2,500. And from there, we go cost of sales, which is a debit of 2,500, and inventory will be a credit of 2,500 because that amount will be coming out of the business, that inventory amount. So asset going down is a credit, meanwhile expenses going up is a debit. And then lastly, we have put a narration there, cash sale of 5,000 plus GST. Always include the plus GST there. Next, we're going to do it to cash purchases. And I want you to note the placement of GST clearing here. So we've got two transactions. So the first transaction, and these both occur on the 2nd of May, Gary's Gardening Supplies paid rent of $2,200, including GST for the month of May, check 66. On the same day, they also paid wages of $1,500, and that's check 67. So one of these incurs GST, the other doesn't. Wages will not incur GST, as we said at the start of the video. So we need to calculate GST first. So we go to our model, we look through, and we see, okay, this is 2,200 including GST. We need to take GST out to get a base price. So 2,200 divided by 1.1 gives us 2,000. 2,000 times 10% is $200. If we add those together, we would get 2,200. So that means our math lines up. Hooray. And then we go to the general journal. You see here, date 2nd of May, the account inventory, debit 2,000, GST 200, also a debit, and bank 2,200 on the credit side. So this time when we pay something, the GST clearing is on the debit. When we received it, it's a liability. It's a credit because we treat it as a liability. Now, why do we treat it as a liability? It's quite simply because when we collect GST, we're expected to pass it on to the ATO, and when we pay the GST, we're reducing our own obligation. So that's the long story short as to why this happens. So let's get on to the second half, which was the wages of 1,500. Quite simply here, we don't pay GST because, again, wages, you don't pay people. So we got the date 2nd of May again. Wages being an expense going up is a debit of 1,500, and it comes from the bank account, which is an asset, makes it a credit of 1,500. So let's talk a little bit more about GST clearing. Now, last year in year 11, if you're still watching as a year 11 person trying to get that edge on year 12, it is called GST liability when it's a liability, and GST receivable. I know. And on top of it, to make it a touch more confusing, GST liability can also be called GST payable. They really looked after year 12 here, where they just call it GST clearing, and you assume it's a liability, even though it can also be an asset. So if we have a look here, we started off with a balance of 800. You can see here, we can have a look here. You see there's a bank of 9,000. That means they received 9,000 GST in cash. And then further down, you got accounts payable 100 and accounts receivable 1,500. That seems a bit weird until you realize the accounts payable is us receiving it. And the only way we would receive something from accounts payable is if they issued us a refund. Because they would refund us back our money, or we would owe them less money, but they would also refund and issue a refund on our credit purchase. Now, if we have a look at the debit, we can see accounts payable 5,000, bank 2,500. That means we paid 7,500 in or towards our GST. So that means we paid GST to that amount. And then accounts receivable is 300. That means we issued our refund and gave the customer back GST. So if there's a refund, the GST will flip. So for example, in accounts receivable, when we receive it or we make a credit sale, we receive GST, but when we issue a refund, it goes out. So where does this go on reports? How does this look on the ledger? If you have a look at the ledgers here, you can see from the first transaction in May, the sale, it is a sale, it's a credit of 500. Meanwhile, if you look at the second of that month, we've paid our 200, that reduces liability. You can see here, based on this, if we were to foot it, it would be a credit balance of 300. So that's important. So how do we report GST, and where would that 300 hypothetically go? So firstly, the cash flow statement. You can see here on the cash inflows, GST received is 500. Meanwhile, GST paid at cash outflow in the operations is 1,100 in the example of Smith's Hardware. That means that anything related to cash in GST will go in the operating activities. On top of that, in the event there is a GST refund or a GST settlement where you settle your account, they would also go in the operations area. But we will cover that in a future period. And then your cash flow statement will proceed as normal. Smith's Hardware. Now, where does it appear in the balance sheet? Current liabilities. If our GST clearing account is like the one in the picture where it's a credit balance, it's a liability. If it's a debit balance, it's a current asset, and that's because we will be owed money, so we get a future economic benefit out of it. If we have the obligation to pay that money to the ATO in the future, then it's a liability. So you just got to remember your definitions there. In this case, GST clearing 7180 on the current liability side means it's that obligation. It is technically a credit balance. So when you pay it off, obviously in this scenario, it will be a debit to essentially make it zero. Again, we will discuss that in a future video. Now, some quick summary rules. If it's a debit balance, then you treat it as a current asset. If GST is a credit balance, you treat it as a current liability. And it's always current because GST can either be paid yearly in a financial year or quarterly using a business activity statement. That is why that is what it is. So, before we wrap up, it is normal for GST to be treated as a liability most of the time. And that being a liability is generally an indication that you are receiving more than is going out. That's because you're going to have a markup on your products. Now, that's not really important. When we go through the theory video, that will make a lot more sense, but it is something to think about. So, my name is Matthew. GST, I encourage you to practice it. You will get the hang of it. Just remember debits and credits, and you will be fine. And make sure you like and subscribe. At cost price, $2,500, and then inventory as a credit, by the way, because it's expense, it's going up. Debit. Let's try that.